Možemo da počnemo? Jao, koliko moj stoji. Dame I gospodo.
Ladies and gentlemen, esteemed members of the press, dear colleagues, welcome to the presentation of the Annual Financial Stability Report for 2018. Before you is a report for the year in which Serbia achieved the highest growth rate in the last 10 years, maintained low and stable inflation, and additionally strengthened the domestic financial system. The year in which long-term investment in our country increased and the share of public debt in GDP contracted further. I have to say that such results were achieved in the face of challenges from the international environment we have all been witnesses to, such as global protectionism, geopolitical tensions, or uncertainties surrounding the UK's exit from the European Union. The Financial Stability Report starts with the ever-important conditions in the international environment because they have a significant bearing on the conditions at home too. At the global level, 2018 was marked by an economic slowdown experienced in the second half of the year by advanced and consequently emerging economies. This put an upward pressure on the risk premia of countries in the region and prompted revisions to their growth outlook. Trade tensions between major world economies also fueled uncertainty in the international commodity and financial markets. In such an environment, the pace of normalization of monetary policies of leading central banks, the European Central Bank and Federal Reserve System, was uncertain. What is the best response of policymakers to growing uncertainties in the external environment? The best, and in fact the only response, is to strengthen the domestic economy. In coordination with other economic policy makers, the National Bank of Serbia has worked continuously towards further narrowing of internal and external imbalances. More stable conditions of doing business reflected in price and financial stability, sound public finance and better prospects were also sealed by the Standard & Poor's upgrade of Serbia's outlook from stable to positive. As the reasons for its decision, the rating agency cited the country's strong economic growth, as well as the results of the National Bank of Serbia in maintaining price and financial stability. Over the past 6 years, inflation in Serbia has been kept firmly under control. So we have kept inflation under control for 6 consecutive years. Inflation averaged around 2% in 2018, while medium-term inflation expectations of the financial and corporate sectors remained anchored. Against the background of low inflationary pressures, but also risks from the international environment, we maintained a cautious monetary policy stance and lowered our key policy rate in 2 25 basis point steps to the level of 3%. So we're talking about 2018. This way, we continued to support economic growth that reached 4.3% in 2018. In July this year, we trimmed the key policy rate by another 25 basis points to 2.75%, which is its lowest level in the inflation targeting regime yet. We expect that this impulse will soon pass through to all segments of the market, thereby extending our support to economic growth going forward. The cost of financing declined, while disposable income of corporates and households increased. Continued monetary policy easing contributed to a further reduction in the cost of financing for households and corporates, as well as for the government. This is evident from the fact that compared to May 2013, when we embarked on a monetary policy easing cycle, interest rates on dinar loans for households are now twice lower, while those for corporates are even 3 times lower. In the case of the government, an evident example is that of 7-year dinar securities, where the interest rate fell from 13% at end 2013 to 3.59% this July. And this is exactly where the effect of full coordination of our policies and the progress Serbia made on the macroeconomic front is best seen. Considerably lower interest rates and the consequently higher disposable income, as well as economic growth accompanied with a rise in wages and the lowest unemployment rate, were the key drivers of lending activity. The year-on-year growth in loans to the private sector was almost 2-digit in 2018, measuring 9.9%, and the loan structure was favorable as well. In 2018 alone, over 240 billion dinars worth of new investment loans was disbursed, which is the highest level so far. This supported the profitability of corporates, which has been on a constant rise since 2015. The corporate sector ended 2018 with a net profit of 500 billion dinars, which is by 126 billion dinars, or by 1/3 more than the year before. If we look at company size, we will see that profitability was in the positive zone in all categories, from micro to large enterprises. Positive fiscal trends extended into 2018. Serbia recorded a fiscal surplus of around 0.6% of GDP. The share of public debt in GDP dropped by 4.1 percentage points year-on-year to 53.8% in 2018, and went further down to 51.8% in May 2019. In the context of financial stability, particularly important is the reduction in the dollar share of public debt in the previous 2.5 years, from around 1/3 to around 1/5 of total public debt in June this year. Also, the country's external position is sustainable. For 4 years in a row, the current account deficit was fully covered by the inflow of foreign direct investment, which in 2018 reached 3.5 billion euros, or 8.2% of GDP. Full coverage of the current account deficit continues in 2019. We have preserved financial stability. In such an environment, pressures prevailed in 2018 as well. The dinar strengthened against the euro owing to good macroeconomic indicators, greater interest in long-term investment in Serbia, and rising exports of goods and services. To prevent excessive short-term volatility of the dinar exchange rate, we intervened in the interbank foreign exchange market on both sides by buying and selling foreign currency. We bought 1.58 billion euros net. This also gave an additional boost to the country's FX reserves. And I have to tell you that with this morning's intervention, we have bought 1.6 billion euros as at today. This additionally strengthened the country's FX reserves, which at end December 2018 came at 11.3 billion euros. At end June this year, foreign exchange reserves reached 12.1 billion euros in gross terms, or over 10 billion euros in net terms, which is the highest level on record. Such a high level of FX reserves ensures security not only in conditions of stability, but also in case of potential external shocks. Serbia's banking sector was adequately capitalized, highly liquid and profitable throughout 2018 as well, with indicators standing high above the regulatory minimums. The dominant role among the sources of funding was that of domestic deposits, which reduces banks' dependence on external sources of funding and their exposure to risks from the international environment. In addition, the results of macroprudential stress tests, which we continued to regularly conduct in 2018, confirm that banking sector capitalization and liquidity would not be jeopardized even in case of extremely negative developments. At our previous presentations of the annual financial stability report, we underscored the share of non-performing loans as a systemic risk. This is also how we tackled the issue, in a systemic way. As a result, the share of non-performing loans in total banking sector loans was lowered to 5.7% at end 2018 and to 5.4% in May this year. And another piece of data, exclusive piece of data, is that at end June, the Npl ratio equals 5.29%. The ratio of non-performing loans is smaller by around 17 percentage points and their stock by around 70% compared to the period when the Serbian government and the National Bank of Serbia adopted the Npl resolution strategy. At the same time, the current ratio of non-performing loans is the lowest on record. Being proactive, last year we also adopted regulatory measures to curb risks potentially arising from unsecured non-purpose lending to households at unreasonably long maturities. Late last year, we signed with the Serbian government the new memorandum on the dinerization strategy, outlining additional measures and activities which aim to encourage further dinerization and reduce foreign exchange risk in the financial system. We are particularly happy about the rise in dinar savings, which are today almost 4 times higher than at end 2012, and which exceeded 70 billion dinars in July this year. This truly reflects citizens' increased trust in the domestic currency. In following the latest trends, we strive to meet consumer needs. Last year as well, we showed that besides being traditional, we always support the development of cutting-edge technologies while ensuring safety and protecting financial service consumers. In this regard, one of the key projects of the National Bank of Serbia in 2018 was the launch of the instant payment system in the Republic of Serbia. The system is an important step towards the digitalization of payment services, enabling instant payments 24 hours a day, 7 days a week, 365 days a year. Ladies and gentlemen, esteemed members of the press, my dear colleagues, low and stable inflation, a cautious monetary policy stance, a stable banking system, and favorable fiscal trends have provided a positive contribution to maintaining and strengthening the resilience of the domestic financial system and macroeconomic stability of the country in 2018 as well. Despite all challenges from the international environment, which were not few, last year saw the lowest unemployment rate on record and an increase in employment and wages, which shows that sound economic policy was pursued in Serbia and that the resilience of the domestic economy to potential risks was strengthened. By consistent implementation of monetary policy and full coordination with fiscal policy, the National Bank of Serbia significantly contributed to the country's solid economic performance, which strengthened the basis for sustainable growth. We are therefore able to talk today about the lowest risk premium, which in July, for the first time since records are available for our country, fell below 60 basis points. Thank you for your attention. These are the data that we also presented to the National Assembly yesterday, to which we are accountable. And before I give the floor to General Manager of the Financial Stability Department, Mr. Darko Kovacevic, I will entertain you with an illustration of the results we have achieved. Darko told me it was easy to go to the National Assembly yesterday when we had a good year. And I told him, wait a minute, Darko, this is not agriculture. And then we had rain, and we have to thank God for good performance. And our colleague, Lada Petrovic, who is also sitting here, told me, well, when it's raining, not only cultivated crops are growing, but also weeds. I hope this illustrates the results we have achieved. Favorable and unfavorable circumstances always exist, but when it comes to people, and there are only 18 people working in the Financial Stability Department who have produced this report, but also many other people working at the National Bank of Serbia are standing behind this report and have provided a significant contribution. Now Darko will present to you the rest of the report.
Ladies and gentlemen, dear members of the press, dear colleagues, welcome to the presentation of the Annual Financial Stability Report for 2018. We will give a short overview of the developments in the internal and external environment, present the key risks and the measures to be taken to mitigate these risks. The report also analyzes the main segments of the financial system, such as the domestic and the international environment, financial intermediaries, that is banking and non-banking sector, financial infrastructure and financial markets. Also, the report presents the results of macroprudential stress tests at the level of the banking sector as at December 2017, and the end of the report contains an overall assessment of financial stability. It, as a matter of fact, quantifies the systemic risk. The report also contains a number of text boxes about some of the key topics concerning financial stability, and it also elaborates on events that took place in 2017 and 2018. So we have the key risks from the international environment and the measures to be taken to mitigate these risks. The slowdown in economic activity at a global level, both of developed and emerging economies, uncertainties concerning the movement of oil prices due to geopolitical tensions, the outcome of Brexit negotiations, and divergence of monetary policies of the ECB and the Fed are the key factors that marked the last year. Also, the divergence of the Fed's monetary policy from the policies of the leading central banks could impact the increase in uncertainty in the international financial market and capital flows. In the conditions of a lower expected global growth, a slow normalization of monetary policy of the Fed can positively affect capital flows to emerging economies and the stability of FX markets of these countries. Given the high presence of banks with foreign capital in the domestic market, the movement in credit activity in the euro area can also impact the funding of subsidiaries in Serbia. According to the survey of the European Investment Banks about credit activity of banks in the region of Central and Southeastern Europe, there was an improvement of conditions of financing of banking groups owing to the facilitated access to domestic sources of funding, primarily deposits of the corporate and household sectors. We are still seeing the risks in the international commodity and financial markets, notably in terms of movements in global oil prices, which have been recovering since late 2018. Also, after the period of extremely low interest rates of leading central banks, in the medium run, we can expect a period of their growth, both in conditions of variable interest rates, and this can trigger an increase in the price of borrowing and burden of the servicing of existing liabilities. One of the important risks is the high level of the euroization of the domestic financial system. Around 67% of loans and deposits of the corporate and household sectors are FX denominated. Given that the currency structure of receivables and obligations, liabilities of banks is not matched, banks are not highly exposed to the FX risk. On the other hand, the fact that a large number of clients borrow in a foreign currency and earn in the domestic currency makes these clients exposed to the FX risk, and therefore banks are exposed to credit risk as well. The high degree of realization weakens the transmission mechanism of monetary policy, which is why the impact of the key policy rate impacts only on a part of the domestic credit market. The second risk, another risk, relates to the frequent phenomenon of non-purpose unsecured lending to the household sector at unreasonably long maturities, which actually mandated the application of targeted measures to prevent the build-up of new NPLs. As we have already said, the global slowdown, uncertainties in the movement of prices of primary commodities, notably oil, divergent monetary policies of leading central banks, and geopolitical tensions are the key risks from the international environment. The slowdown in the euro area impacted on a rise in the risk premium of countries of Central and Southeastern Europe in 2018. We should also emphasize that the projections of the economic growth of the euro area are still marked by a high level of uncertainty due to Brexit and mounting geopolitical and trade tensions. Euro area inflation has been moving below target values, and at the end of the year it touched 1.5%. Responding to low inflationary pressures, the ECB kept interest rates at the lowest level, emphasizing the expectation that interest rates will remain at the current level at least until the first half of 2020. On the other hand, the Fed continued with the normalization of monetary policy and implemented 4 hikes of its rate in 2018 and continued to reduce its balance sheet, which began in 2017. If we compare the stability of the domestic system compared to 2017, we can say that the stability has been buttressed primarily owing to the significant reduction in the share of public debt in GDP. The share of public debt in GDP equaled 53.8% at the end of 2018 and was reduced by 4.1 percentage points compared to the previous year. According to data of the Public Debt Administration, at early 2019, we saw a further reduction in the share of public debt, and this share now stands at 51.8%. The current account deficit remained at the same level as in 2017 and equaled 5.2% of GDP. As in the previous years, the current account deficit was fully covered by FDI, which suggests long-term sustainability of the external position. We have also seen the continuation of positive fiscal developments from the previous year, with a fiscal surplus equaling 0.6% of GDP. Real GDP growth in 2018 came at 4.3%, which is the highest growth in the past 10 years, and it was led by investment, private consumption, and exports. In the coming period, we expect further economic growth, which will reach 3.5% in 2019 and 4% in the years to come, with the maintenance of a favorable growth structure. Low inflationary pressures were present throughout 2018, and inflation was low and stable. Also, the exchange rate was relatively stable. At the start of the previous year, we saw mild depreciation pressures triggered by the tightening of the monetary policy of the Fed and the seasonal demand of energy importers for foreign currency, but these negative effects were mitigated by the timely response of the NBS. Since February 2018, we have seen appreciation pressures. Owing to a stable macroeconomic environment, a high inflow of FDI, and higher risk appetite of foreign investors to invest in long-term dinar securities, in 2018, the dinar strengthened by 0.2% against the euro in nominal terms. The NBS continued with cautious easing of monetary policy. The key policy rate in 2018 was lowered by total 0.5 percentage points to 3%. Beonia continued to move below the key policy rate throughout the year. A stable macroeconomic situation, the cuts in the key policy rate, a stable exchange rate, and low and stable inflation brought about the improvement, that is, brought about the upgrade of the credit rating outlook, and this also brought about a reduction in the country risk premium to the historical low at the start of 2018. The cuts in the key policy rate to the lowest level in the inflation targeting regime, together with higher interbank competition, a lower country risk premium, and low interest rates in the money market in the euro area, contributed to credit growth of 9.9%. Faster growth in credit activity was prompted by the acceleration in year-on-year increase in corporate loans to 8.1% and household loans to 12.5%, even in conditions of the continued efforts of the bank to resolve the NPL issue. The reduction in interest rates and more favorable market conditions will continue to positively affect credit activity and economic growth as well. Owing to strong economic growth, reduced the price of corporate borrowing, and maintained stability of the exchange rate, companies reported a positive and excellent business result in 2018. The highest profitability was recorded in the sector of mining and manufacturing. Profitability also increased in construction, which indicates the recovery of this sector and the real estate market. The net financial result of the corporate sector equaled 500 billion dinars and was by a third higher compared to the previous year. Domestic corporate loans increased by 8.1%, despite the significant NPL write-offs and assignments to the persons outside the banking sector. Excluding these effects, domestic loans to the corporate sector equaled 11.6% year-on-year. The credit risk of the corporate sector, measured by the share of NPLs, equaled 5% at the end of 2018 and was reduced by 5.5 percentage points compared to 2017, owing to the activities aimed at resolving the NPL issue, as well as the collection, write-off and assignment of a part of NPLs. Positive economic developments also impacted the labor market in terms of higher employment, a reduction in the unemployment rate to the lowest level, and rising wages. Owing to NBS measures and successful implementation of the NPL resolution strategy, at the end of 2018, gross NPLs made up 5.7% of total loans, which is the lowest level of NPLs since this ratio is monitored, and which is by 4.2 percentage points lower compared to 2017. According to the latest data, this share is even lower and stands at 5.4%. In terms of the sectoral structure, the share of NPLs is somewhat higher in the corporate sector than in the household sector, but these loans do not jeopardize financial stability, bearing in mind their level and the coverage by allowances for impairment. In 2018, the banking sector recorded a positive financial result and was more profitable compared to the previous year, with the return on equity of 11.3%, primarily due to rising interest income and a reduction in net credit losses. Although profitability indicators are high, they are somewhat lower compared to the region average, which equals around 14%. Also, the first half of 2019 indicates that the banking sector will post profit this year as well. The capital adequacy ratio of the banking sector at 22.3% in December 2018 is above the region average, and it is much higher compared to the minimum ratio prescribed by domestic regulations. In the structure of regulatory capital, with around 95%, the highest quality Tier 1 capital is the most prevalent. In terms of the assets of the banking sector, we still have the bulk of loans that make up 63% of assets, which says that banks are oriented to traditional credit deposit activities. Cash and balances with the central bank make up around 16% of total bank assets, which suggests high liquidity of the banking sector, whereas financial assets make up 18% of assets and are mainly made up of securities of the Republic of Serbia, which suggests that banks are more prone to make safer investments. When we talk about the sources of funding, the bank in Serbia rely on domestic stable sources of funding. Total deposits made up 72% of assets at the end of 2018. The strengthening of the domestic deposit base enables bank to lower dependence on parent companies, which reduces the exposure of banks to risks from the international environment. In terms of the results of stress tests, the credit risk is the most important risk in our banking system, and it accounts for over 84% of total capital requirements. To assess the resilience of the banking system at a level based on macroeconomic scenarios presented in the report, we have projected the movement in the share of NPLs within 1 year. According to the baseline projection, we have forecast a further reduction in the share of NPL, whereas the capital adequacy ratio would increase from 22.3 to 23.7. According to moderate scenario, the ratio would equal 21.5%, whereas according to the worst case scenario, the capital adequacy ratio would equal 19.2%. This means that this ratio, even in the conditions of the most unfavorable movements, would remain significantly above the regulatory minimum. When we talk about the liquidity risk, even in the case of the worst case scenario, which implies a twice higher shock than the one that took place in October 2008, and I'm referring to the withdrawal of around 21% of total deposits. The banking sector would remain liquid with the liquidity ratio of 1.25, and this ratio would be significantly above the regulatory minimum. Stress tests indicate that even in the conditions of the worst-case scenario, our banking sector would remain adequately capitalized and highly liquid. The insurance sector recorded positive trends in 2018, and this concerns the good capital adequacy and rising premium and return. The net result of insurance companies at the end of 2018 equaled as much as 8.9 billion dinars, with the return on equity of 17.2% in non-life and 9.3% in life insurance. We also saw an increase in the share in assets of financial sector from 6.3% in 2017 to 6.7% in 2018. The sector of voluntary pension funds continued to record positive results, reflected in rising net assets by 11% and the rate of return on Fondex of 5.5%. The sector of financial leasing also recorded positive developments concerning an increase in assets by 15% with simultaneous reduction in NPLs and a positive business result of 1.6 billion dinars, which, given the size of this sector, represents a very significant business result. The period from January to December 2018 was marked by high stability, with the exception of a somewhat high level of stress at the start of the year, both in the capital market and the money market. This relates to the continuation of seasonal depreciation pressures from the end of 2017 and the volatility of turnover on the Belgrade Stock Exchange. The improved outlook of the Serbian economy, a reduction in public debt, and a fiscal surplus have contributed to improved macroeconomic performances of Serbia, which was recognized by international institutions as well. This pushed down the country risk premium and approved the outlook for the increase of the country's credit rating. The domestic banking sector is adequately capitalized, highly liquid, profitable, and with the lowest level of NPLs since this ratio is monitored. Also, the non-banking sector recorded important, significant business results, which altogether contributed to the low level of the indicator of systemic stress in 2018. Thank you for your attention. I would just like to make a correction that at the end of June this year, the NPL ratio is not 5.3%, but 5.21%. Željko showed me this data. This is preliminary, but it will be final data. So 5.21, which is a decline from 5.4 to 5.21, which speaks about our continuous and diligent work in terms of the reduction in the NPL level.
Alexandra Stoilkovic, Pink Television. Yesterday, you said at the National Assembly that foreign direct investment equal around 2 billion euros this year. Could you elaborate on this? What drove this inflow of foreign direct investment? Yesterday, we heard about the new investment by a Japanese company. Yesterday's piece of news is not factored into our figures. This is what is called an upside risk relative to the projections we have. When it comes to estimates of foreign direct investment, they will be elaborated in more detail at the next inflation report presentation. In the second half, ending with the second decade of July, in Serbia, we have recorded 2 billion euros of foreign direct investment, which is significantly beyond our expectations. The upside risks to our projections are founded, but you know the approach we take. We will talk about them once these investments actually materialize, and we think that they have materialized once the money is on accounts in Serbia. What is most important is that the inflow of foreign direct investment is effectuated through investment, through works, through construction, because this is the only thing that is reflected in GDP growth, which is the true measure of everything we do. We at the National Bank of Serbia, by ensuring macroeconomic stability, by creating favorable environment for investment of both foreign and domestic investors. And these are the reasons which speak in favor of the fact that many people decide to invest in production capacities and in services here in Serbia. But we are also equally pleased when they decide to invest in our securities, especially those of 10-year maturity, which was the case at the London Stock Exchange. At the recently completed roadshow, we managed to get an interest rate just as the countries which have 2 notches higher investment grade and credit rating than we do. We are not complaining. We are working with great commitment and passion, and we are pleased that macroeconomic stability has been recognized, political stability has been recognized by investors, and sound public finances. This is what drives foreign investors to Serbia. These are the reasons why we have also changed the structure of investors in our securities, and now these investors belong to the group of the smartest and best informed investors, but they're also the most sensitive investors. And when I say this, we can all recall the episode of 2014 when a large investor shook our monetary ship because he entered and he left Serbia during the elections. But now we have investors from the United States, from Europe, who invest on a long-term basis. They do not expect high yields, but they know that Serbia is on the path of sustainable growth, and they are keen to invest in Serbia, accepting lower yields. And this is something that singles Serbia out compared to other countries. And if you ask me what is the main reason for this, then I will tell you that we are not led by short-term results. We do not think about the time dimension of one election cycle. We do not think like many bankers do when they are determining their market share. They are measuring it only by the length of their term in office and the size of their bonuses. This is not what we are guided by. The long-term commitment of Serbia to forge its own sustainable path is something that is recognized and is reflected in new factories, job creation, better payment capabilities of purchasing power of citizens, and so on. And this is the circle that is called success breeds success. But as you know, success is also never forgiven. And I will add that it is not forgiven even when it benefits all the people, because macroeconomic stability and political stability in Serbia is a public good enjoyed by all, irrespective of the fact that they mind that they missed the chance to contribute to that success and to that stability. I apologize for taking too long, but this is the complexity of our joint decisions, and this has led to this situation where Serbia is now recognizable on the investment map. And that is why we have investors from Japan coming. I was also happy that that some other investors came here. I'm not happy that they are taking our staff away from us, but we always try to see the positive things in everything.
The IMF suggested or advised you to allow for somewhat higher volatility of the exchange rate in both directions, and will the OTP be licensed, OTP Bank? The first question is the question that I answered last time when we had a conference, and I will reiterate my statement. To listen to a piece of advice of a strong institution, you have to be sure that this advice will promise to you at least somewhat better results. So only under these conditions should you listen to somebody's advice. But what better results can you expect in terms of stability, dollarization, and so on, if you allow for higher flexibility of the exchange rate? I will tell you openly, regardless of some of these pieces of advice, at the very institution of the IMF, and they make decisions, they didn't have a unanimous stance about whether Serbia needs a higher volatility of the exchange rate. On the contrary, there were also opinions when they said that at the moment when in Albania they applied high volatility of the exchange rate, Albania began to face a higher increase of euroization, of total euroization in their country. And even without the case of Albania, which actually refutes the benefits of higher volatility, I want to reiterate that we are a partner of the IMF. The arrangement is our ownership, and the IMF for Serbia is a partner to which we talk, but we don't resemble people who listen to advice without making the calculations of the effects. And if I say that we have 70 billion euros of dinar savings, this is the best proof of citizens' trust in the policy that we pursue and in the stability, including the stability of the exchange rate that we are talking about. Citizens who find it very hard to get rid of this memory of hyperinflation when wages within 1 hour were devalued by hundreds of percent, and when you had to know the bank teller clerk so as to buy foreign exchange, then you can imagine how determined we are in pursuing our monetary policy. So Today we bought 1.6 billion euros to prevent extreme appreciation. Since April 2017 until today, we have bought over 4 billion euros to prevent excessive appreciation of the dinar. I think the answer is contained in these data. The second question, OTP from Hungary in May this year submitted the application with the NBS to acquire ownership in Société Générale. This case is being processed. You're familiar with our competences and responsibilities. We are working on this, bearing particularly in mind the fact that Société Générale is one of systemic banks, and the role of OTP Bank will increase significantly if this process was concluded successfully. So the owner of two important banks, this is very serious, and we are working on this, and you will be informed in a timely manner about this issue.
They have just explained that greater volatility of the dinar would increase dinarization. Do you believe in their explanation? How will greater volatility contribute to greater confidence in the stability of the dinar and in the process of dinarization? I'm telling you that it is exactly the reverse result that has been achieved in Albania. This is why we have acknowledged their advice, but we are thinking on our own. And like I said yesterday in the Assembly, I'm happy that we went to the National Assembly with good results. We had a good year. And the only assessment I expect from the citizens is in the form of increased credit activity, increased economic activity, and increased dinar savings. And these estimates, through citizens' confidence, are received on a daily basis, and there is no reason at all to change our policy, which yields good results. Why should we change a good team and a policy that produces good results? Just to be liked? I don't think that's the case. I'm not in the years when I wish to be liked. My primary concern is to achieve good results. The announcements from Croatia that they could claim some deposits and all foreign exchange savings by Jugobanka Split, is this a part of some of the previous restitutional negotiation team? Because we are talking about 1 billion euros plus interest. There are people who, in mutual relations and in professional relations, when you are distributing and dividing assets and liabilities of the former state, they are guided by the principle, we'll try it, and if it goes through, it goes through. I think that everything that has been done, in the sense that we believe that the other party will honor its commitments, but everything that has been done does not give us the right not to count on reciprocity principle. When it comes to the restitution of the assets of our companies who had assets in the former republics, then the return of our citizens to those countries, I think that elementary respect requires us to behave, by the principle, do as you would like to be done by.
I hope that the annual financial stability report is informative enough for you, and I hereby would like to announce the presentation of the inflation report, our quarterly report, which will contain some unique text boxes which speak about why we are different from the countries in the region. So we are recording an increasing export of services, and we also have serious analysis that we conduct in-house. And to you as journalists who deal with the economy, I believe this is somehow improve your work, help you in your work, and our analyses are highly illustrative. And all the measures that we adopt, we do not adopt them because we are stubborn, but because they're well measured, and we also have a good team of people. We have people to work for, and we also have the people to work with. And I also refer to you here. And thank you very much. We remain open. And Mr. Stoyev, I would like to say that I'm sorry that our very good interview did not receive a lot of attention on the radio television of Serbia. It was not presented in a proper way, but I believe today it is much more important to have long-lasting stories. But when you have good results, this goes without saying, and good results do not even deserve the explanations of how these results were achieved. Thank you very much once again. If you don't have any further questions, thank you very much, and we will see each other soon.